Walmart's equity multiplier in 2013 was 2.66. This is calculated by taking total assets of $203 billion and dividing by the $76 billion in total equity. Harley-Davidson's asset-to-equity ratio in 2012 was 4, and the asset-to-equity ratio for PP&L in 2011 was 3.94. We had $3.94 in assets for every dollar in equity, and for Apple in 2011 it was 1.52. What were Harley-Davidson's total liabilities at 12/31/2012? We're given their total assets of $9,170,773,000. We subtracted from that the total equity of $2,557,624, and we get total liabilities of $6,613,149,000. Remember, zeros are omitted. As of December 31st, 2012, Harley-Davidson used $1 in equity and $3 in liabilities or debt to fund every dollar in assets. Recall our accounting equation has to balance. $4 in assets will equal $3 in liabilities plus $1 in equity. And that's what our asset to equity ratio is telling us. We've got $4 in assets for every $1 in equity. So the plug is debt of 3. Harley-Davidson relies more heavily on debt to finance its assets than it does on equity. And an equity multiplier greater than 2.0 means that a company uses more debt than equity to finance its assets. We would say it has higher financial leverage. On the other hand, an equity multiplier of less than 2.0 means a company uses less debt than equity, and it has lower financial leverage. Which companies use less debt than equity to finance their assets? Well, only one company has an asset to equity ratio less than 2, and that would be Apple. Over the past 3 years, which company's financial leverage decreased? That would be Harley-Davidson, and we can see its asset to equity ratio decreased from 4.27 down to 3.59. So for every dollar in assets we have, or equity, we have less in the way of assets today. If the asset to equity ratio accurately measures a firm's financial risk, which company at the end of 2012 is assuming the most financial risk? This would be the company with the highest asset to equity ratio, which would be PP&L, with an asset to equity ratio of 4.16. It has $4.16 in assets for every dollar in equity, which means it's using $3.16 in debt. As evidenced by their asset to equity multipliers, or asset to equity ratios or equity multipliers, Harley-Davidson and PP&L have roughly comparable asset to equity ratios. However, I would have to say that Harley-Davidson faces more financial risk. This is because Harley-Davidson operates in a much more cyclical industry. In other words, its business prospects change much more with the overall economy, and it also faces more competition. We can see this if we compare their profit margins and asset turnover ratios over the past 3 years. Harley-Davidson's profit margin increased significantly from 3% to 11%, while PP&L's has stayed relatively constant between 11 and 12%. Harley-Davidson's asset turnover has improved more over this period of time, while PP&L's has stayed relatively constant. And these two combined measure our operating performance, our return on assets. And we can see Harley-Davidson has experienced a lot more volatility in its return on assets or operating performance than has PP&L. This suggests that Harley faces greater uncertainty in generating cash flows in the future and meeting future debt obligations.